The psychology of holding long term. As we continue with the long term investing series, I wanted to discuss some of the tactics and tools that I use to overcome the psychological issues that I face myself in holding things for the long term as long term investments. Because it's not so easy. It's not so easy to hold things for a long time, at least for my personality. Perhaps you can relate to that as well out there. Anyways, I want to make a big note right here that what we're going to discuss in this whole presentation does not imply to literal shit investments. If you invested in shitcoin XYZ, unfortunately, I don't think that these methods are going to be relatable, unfortunately. Anyways, we'll move on here and we'll get into the next slide. And here's a chart of Bitcoin since basically the dawn of time in 2010. And if you look at this chart, like many people, you will probably think something to the tune of, wow, people who bought early were so lucky. This was so easy. And ultimately, I have to say that one, I was probably among those people when I first came into this space back in 2017. But I can assure you, I am not anymore because it is not easy. Why is it not easy? Well, one, holding for a long period of time, years and years on end, is difficult in and of itself because patience is a virtue, as the saying goes. It's not easy to be patient for these sort of things, which naturally take a very long time. Capitulation by boredom is a real thing and very, very common, even for just months at a time when we see price action go sideways. Imagine a year of sideways price action and not feeling that urge to sell, especially if you are, up a big amount. Or especially, let's say you bought over here. You bought in 2012, great price. It was probably like $10 at that time. Bitcoin rallies up to $1,000. It would take everything inside of me and more not to sell probably, significantly before that, or even after a parabolic blow off top like this, where price action comes down 80% or more, to not pack up my bags, at some point during that time. It is extremely difficult, extremely, extremely difficult. So that's what kind of spurned upon the whole idea for this presentation, because in my estimation, it's not fucking easy. There is a skill in holding, and that's what I want to discuss, is some of the things that I feel like have helped me a lot in this journey. And again, I am still a novice when it comes to long-term investing. I've only been in the game for about 6 years, I'd say, and realistically, I probably need to triple or quadruple that. So this is more of an ongoing sort of learning process where I'm sharing with you as I kind of learn things, at that time. Of course, if we fast forward 10, 20, 30 years from now, I'm probably going to have a different set of beliefs. Anyways, let's move on from there and let's get on with some more assumptions here. So I want to put these assumptions out right near the beginning before we go into the actual tactics, because without these assumptions being true, the tactics will not work. Just straight up, they will not work. The situation does not apply to you. That's fine. I mean, maybe you have your own, your own secret sauce. In fact, you most likely do. But these are the assumptions. One, no leverage. We cannot have leverage in long-term investments. Why? Because even if you have a chart that goes up and to the right like this, seemingly for forever, or at least for its current history, which may not be the case for forever, but you still will get significant drawdowns. It is not unheard of, even in more traditional assets, which I thought of as more legitimate, to have flash crashes like we saw during a black swan in March 2020. That would bring things down, about 50%, in some cases a lot more, but even on a 50% drawdown would liquidate you at 2x leverage. So think about it that way. I mean, that is considered extremely low for cryptocurrency people. Obviously, for traditional market people, that's less of an issue. But yes, if you are going to hold things for a long period of time, naturally, the probability of you experiencing a black swan event during that time goes up and up and up the longer that you hold it. And realistically, we've seen multiple black swan events, or just maybe not even black swan events, but multiple, once in a lifetime type event corrections even in the past 5 years. We saw of course, Rona dump. We saw when oil went negative. No one thought that was possible. I mean, very few people would even know that that's possible. We also saw, of course, the flash crash in 2003 and 2023, 2024, and even again in 2025, although not as bad for Liberation Day, but in August of 2024, that flash crash, of course. And then of course, in 2023, we had the banks failing, another big one. In 2022, there was Luna 3AC failing, FTX collapse, all of these sort of things. So if you don't think that these mega moves are possible, you're just not prepared because you have not referenced history and been accustomed to what is actually possible. So leverage is not possible when holding long term, point blank, period. Anyways, liquidity not needed for emergency, meaning that these are investments that you are putting aside and you intend to hold for a very, very long time, and you do not need the cash in any way, shape, or form for your day-to-day expenses. That means that this money is effectively dead to you once you invest it. That's the way that I think of invested money. It's dead money. I don't even consider that I even own it for the next 10 years, basically. That's my sort of perspective. I put a minimum here of 5 years. I think that's appropriate for Bitcoin people, but if you're in traditional markets as well, I would extend that. It doesn't necessarily have to be 10 years, but let's say definitely more than 5 years, like let's say 8 years. That's a good middle ground. Anyways, and then number 4, just kind of reiterate the initial point, assets that you're holding are not garbage. We cannot hold garbage assets, and these things to be true. There are situations, in fact, for many things that they will just go down into the right for forever. Holding those things over a long period of time is not going to improve your results, unfortunately. And of course, you can watch previous videos for defining, what would effectively connotate a non-shitty investment. And then again, just no leverage. Seriously, no leverage in long-term holds. For fuck's sake, don't do it. Or at least if you're going to do it, this content just does not apply to you. Maybe, like I said, maybe you have your own secret sauce. That's fine. I'm more than happy for you. But in this case, I personally do not employ that and will not be coming at it from the perspective of that. Anyways, let's go over a familiar situation. I know that I've dealt with this in the past, and I'm sure many of the people as well. You enter into the long-term investing game with all the excitement, all the exuberance. You've done your research. You feel confident in your choices, and you click the green buy button, which is the easiest part of long-term investing, just hitting the button. Almost immediately, or perhaps maybe even takes a month or two, who knows, price starts going against you. Price goes down 20%, and your prized assets are losing value. But you tell yourself, I've done my homework. This is just a dip. It'll bounce right back. It has to. But deep down, you're already uneasy. No one feels good losing value. 20% in cryptocurrency, not thought of as that much, but hey, 20% for most people is significant and potentially even life-changing. Stage number 2 is the anger stage, which comes after denial. And as those losses drag on, maybe it's a time component of it. Maybe you're holding that 20% loss for months and months at a time. You start to, grind down at that. Maybe the loss just gets bigger. You start to, get frustrated. You start to get angry. You start to curse. You're like, fuck this shit. Like, fuck you. You curse whoever, first told you about this great idea to invest in. And you curse the sky. And most of all, you start to curse yourself. You're like, God damn, I'm so fucking stupid. How the fuck did I listen to these people? Like, God damn, fuck. We've all been there. Stage number 3 is bargaining. The anger starts to shift. You start pleading in your head, please, just let me get back to break even. If that happens, I swear I'll sell and never touch this stuff again. I promise, whoever you believe in. Suddenly you've turned into a desperate negotiator with the market gods. Unfortunately, the market gods do not give a fuck. They don't give a fuck about you. But that also is positive and negative. They don't give a fuck about you, which can be liberating or also disturbing, but it should be liberating. Anyway, stage number 4 is depression. You start to get used to everything because it's gone on for so long. So the market is not obeying. The weights, really start sinking. You feel regret, shame, maybe even hopelessness. You start to wondering why you're even foolish enough to believe in the first place. How this could possibly work. Like, God, I was so stupid. I was so fucking stupid. And then stage number 5 is acceptance. After a long enough period of time, you naturally start to accept that as a new normal. You get exhausted, broken, you accept your fate. Many investors hit the sell button here, locking in a massive loss and walk away convinced they'll never make such a mistake again. Which may or may not be true, to be honest. I mean, just because you made it in the past doesn't mean you can't make it in the future. In fact, quite the opposite. But of course, there are lessons that we can learn from this to avoid this situation. And here is really the underpinning of everything that we're going to go over in this whole presentation, which is ultimately this is a game of defining what is within your control and what is outside of your control. Maximizing your actions for what is within your control and deprioritizing anything that is outside of your control. That is really the crux of everything here that we're going to be going off. And if you just want like one North Star, one heuristic to be working with, this would essentially be it. This is the philosophy of long-term investing, which is more or less Stoicism, which is more or less, I mean, a lot of different philosophical schools, kind of have a similar version of this, but basically focus on what you can actually control, disregard the rest, and let the chips fall where they may after you take your actions. That's what it all comes down to. Easier said than done, of course, just like it's easier said than done that you're going to hold through this whole fucking period here for Bitcoin for 15 years and get all kinds of 1,000, 10,000 X's from your entry. It is easier said than done, absolutely. But there are tactics that we can employ to make this easier. At least I found tactics that certainly make it easier for myself. And let's get into some of these after understanding why emotions hijack logic in investing. So we need to understand the literal physiology in our brains as to what sort of state makes us do dumb shit, so we can do what's in our power to avoid this. So when humans enter a heightened emotional state, so this could be fear, this could be anger, this could also be euphoria, so both positive and negative. Both positive and negative are equally as destructive, at least potentially. Once that state occurs, your brain's amygdala activates strongly, and that's what triggers the fight or flight response. Now, when you are in that fight or flight response, the activity in your prefrontal cortex of your brain gets reduced. And they've done brain scans, proving this and showing this. And the reason why that is important because that's the part of your brain that's responsible for rational decision making, like impulse control and long-term planning. So literally, when you enter into that heightened emotional state, you are blocked off from making logical decisions. That is why in the moment you will feel very, very strongly one way. But if you were to zoom out and maybe look at the problem, a week later, you'd have a completely different perspective. It's because you have a different portion of your brain operating during that time. You're in fight or flight mode. You're not in logical long-term planning mode. I'm sure you already can guess which mode is more conducive to successful long-term financial decisions. Fucking obviously, you want to be in that logical state of mind. That's where we want to use that sort of a thing. We want in that emotional state when we are in a fight, or actually, maybe not even so much then. Like if you actually learn how to fight, you also understand you kind of want to be calm during that time. But anyways, that's beside the point. So the main thing here is emotion literally blocks logic. We lose access to the part of our brain that weighs probabilities, evaluates risk, and thinks in decades instead of minutes, which is, that is exactly what we do not want to happen when we are coming at this from a long-term investment perspective. And you could even apply this to short-term trading and investing as well. You need those logical parts there too. This is effectively why investors panic sell at the bottom or FOMO buy at tops. Their decisions are driven by survival circuits, not rational analysis. They are just not in the right mind space, and they're probably not even aware of these phenomena that's going on. And I referenced some scientific studies here as well. You can read into those, of course, if you like. That kind of explains where these conclusions came from. But again, the major conclusion that we need for our purposes is that emotions shut down logic. So we want to ideally reduce that emotional state as much as possible or gain some sort of awareness of when it's occurring so that we don't get in our own fucking way. Fucking key. Anyways, rushed investment decisions are a natural result of failing to prepare psychologically and also, in just the actual strategy portion as well. But we're kind of assuming that that's taken care of in this presentation. Again, reference other videos in this series if you want more like how-tos on that portion, because that's obviously equally as important here. Anyway, so logically, we can look at any chart of a relatively strong asset and see that there are volatile periods of upside continuation, downside correction, and sideways consolidation. You look at Bitcoin, there are many instances of this, but even if you go into traditional markets, you're going to get all of these, all of these things happening at some point in time. And so bear market, basically downside corrections, they're not just likely, but they're a certainty, just as an upside, major breakout, or even a major long-term sideways consolidation that lasts a year or multiple years. If you're in traditional markets, it can and will happen. So if we know by referencing the past that these things are possible, what is within our control to prepare for this in the future that could help us? Well, we need to focus on those historical charts, recognize what is possible, study what's in those charts, study the historical examples of and all the specifics of them that can kind of give us an anchor point. Again, we need an anchor point to go back to during those highly emotional times. So what could that look like? It could look like, figuring out what the average drawdown is, how long those corrections take on average, how often they happen, these sorts of things. That's within our control and can give us a nice anchor that we can reference back to when we are in one of those crazy emotional times. And hopefully we'd have just enough logic during those times to go ahead and reference our notes and be like, hey, I wrote this down over here. Are we, within the realm of possibilities? If we are, okay, great. I shouldn't do anything. If we're not, maybe I consider doing something. Anyways, like I say, it is on ourselves to prepare psychologically to hold an asset during periods of intense market volatility, both up and down, and even sideways as well, though those aren't volatile periods, but they are boring periods. And that is also a cause that typically makes people do something that they otherwise wouldn't have. Anyways, as I alluded to in the prior slide, we want to reference the past. That is our major tool in this. In fact, our best tool and maybe even our only tool. It's referencing historical charts that can give us a realistic view as to what to expect. If it happened in the past, it can happen in the future. And of course, even if it didn't happen in the past, it certainly can happen in the future as well. But this is the beauty of using, more long-term, long-existing assets, because then you get more history to reference, and you're probably going to be more within the bounds of that. This is an issue with newer assets, of course, because you don't really have a good reference point. So you have to, kind of employ some other tactics as well. Anyways, if something has happened in the past, then it can repeat in the future. The reason may be different, but the effect on price is the same, and that's really all that we care about anyways. Thus, we will prioritize price to determine what is within the realm of possibilities and to be expected. And again, price, as we went over in prior videos as well, is, it's the most objective feature of any asset. That's what people are actually willing to do, to buy or sell. They are literally putting their money where their mouth is, which is an American saying. I don't know if it's the saying anywhere else, but it's like that's what you actually will do. Talking about something or having an opinion about an event is not the same thing as what doing an actual financial action is. Like, that takes a lot more. Anyways, this is where we should really use our obsessive powers to study the charts. So I say this from a place of love because, I've seen a lot of people like coming up in this trading game, and also myself as well, and they think like spending as much time literally pressing the red and green button is what, and obsessing over that, it's like what's going to make them a better trader. And there is a degree of that, yes, but realistically, where you should use that obsessive power is in the pre-planning stage before you even ever take a trade. So this is the time where we want to start to calculate stuff like I alluded to earlier, like your average drawdown, what's the average time spent in that drawdown, what have the outsized variations, the black swans looked like, how long have these corrections typically taken, what was the maximum, what was the minimum, you could even draw significantly more statistical measurements of these sort of things, but they give you a sort of basing point to reference everything else off of, because obviously without that, you have nothing to relate it to. So this is the best that we can do. So again, where to place your obsessive powers? We want to obsessing over the current chart, the current price chart after already making the initial. This is also what I see a lot. Like, people will make a trade that is supposed to be like a swing trade on a daily time frame or a long-term investment. It's supposed to be held for like 5 to 10 years, and then they'll go ahead and reference like the hourly time frame or the 15-minute chart, for fuck's sake, or any time frame in between. Or just any time frame that is not the one that is even relevant to the one that they're looking at to begin with. And of course, looking at that chart is not going to do anything. That is where you have absolutely zero power. Your eyes being on the chart do not influence the price going up or down. You are wasting your time. And more importantly, and even worse, you're taking your time away and reducing the opportunity cost by not focusing on something that actually could be productive. Like maybe, another income producing activity, perhaps. So yeah. Compulsively checking the charts, not going to help you in these cases, or mostly ever, to be honest. Anyways, so where do we have control? Obsession can and should be weaponized in the strategy creation and testing phase. This is where you need to apply your autism. This is where I apply my autism. Strategy creation and testing and just ideation, these sort of things. This is where you may use historical charts to help guide your future decisions. This obsession should lead you to, at minimum, define an objective entry, exit, and risk management plan based off of objective indications. When I say objective indications, it needs to be a 1 or a 0, or just, some mathematical equation, ideally, so that there is no question in the moment if it's true or not. Is it a 1 or is it a 0? Is it a yes or it is no? Is it a fuck or is it a not? It can't be like, I have my line over here, but it kind of, or I'm waiting for the Fed to come out with this decision, but I think maybe this might happen. And like, if it goes up by a little bit, I'll do this, but I don't know what a little bit is. These things make it impossible, in my opinion. Because when you inevitably run into one of those situations where you are in an emotional state because something crazy has happened, you are going to fight an internal battle if you don't have an objective indication that is literally a 1 or a 0, because you will backwards rationalize in your mind. You will just not be sure, and you need to be decisive in those moments to either take an action or not based upon an objective signal. That is my point here. If you don't have that, you make the game so much more difficult for yourself, to the point where I wouldn't be able to do it. Maybe you can find a way. I cannot find it myself. Anyways, let's talk a little bit more about loss aversion and behavioral psychology, so we can talk what I think a lot of people deal with, which is dealing with losses. Why losses feel worse than gains. We need to understand the psychological fallacy to understand how we might be getting in our own way when we are in a losing period for our investment. We're holding an investment that's intended to be held for 5 years. We're in week number 2, and it goes down 20% against us, for example. So why losses feel worse than gains. Psychologist Daniel Kahneman and Amos Tversky, in their groundbreaking prospect theory in 1979, demonstrated that people experience losses about twice as strongly as equivalent gains. I want to repeat that. This is very, very important to understand. When you take a loss, it feels twice as worse than a gain of equal dollar amount would feel good. So in other words, losing $20 hurts about twice as much as gaining $20 feels good. It's kind of a weird way of saying it, but this is called loss aversion, and explains why investors often panic sell at lows, amongst other things as well. The emotional pain of loss overwhelms rational decision making, which is really why, and again, when we go off of this data here, the reason why I really want to highlight this one is because, again, we know that being in that emotional state is going to be deadly towards whatever financial decisions that we may be making. And when we're losing, it gets amplified. It gets amplified is my point. So this is, for most people, much worse when you're losing. And I know for myself, it's also worse as well. So later studies confirm that this bias is universal across cultures and even shows up in brain scans. So this is basically universal for humankind. And the brain's threat centers light up more intensely when facing a financial loss than when registering a gain. So again, understand that if you start with $100 and you lose $20, that feels significantly more worse than if you start with $100 and gain $20. So it's more likely that it's not more likely, we are going to get more emotional in that losing phase. So just be careful when you are in a losing phase that you are so much more sensitive emotionally to be making bad decisions. It's really one of those times to take a deep breath, focus, step back, and try to look at the bigger picture, reference your data, reference your homework, and ask yourself the question, am I actually doing something that I should be doing or not? What was my plan beforehand? And again, there's an evolutionary reason for this, by the way. It was more significant to our survival when, things were a lot more scarce in ancient times to not lose something than it was to gain something. Like, let's say, you were fucking, I don't know, it's like 15,000 years ago, you're living in a tribe, and and you have like a stake in your hand. Obviously you don't have a stake, but you have a stake in your hand. It's much more detrimental to lose that than to gain another one if you already have one. Why? Because, well, you need to fucking eat, and it's hard to find. It's scarce. Anyways, so this also works the other way as well, to be fair. It's not just when you're losing, it also is when you're gaining as well. But like we went over earlier, it's, for most people, a lot more amplified when you are losing. But it does happen when you're gaining as well. So when your investments are at an all-time high, here is a tactic that I genuinely practice every time I look at my investments when they are basically at all-time highs, more or less. And I look at my total portfolio value, and I prepare my mind by meditating on that portfolio value being, 30 to 50% less than what it currently is, or whatever my average drawdown is based off of my long-term investment studies. Like if I've looked at Bitcoin and I find that those long-term drawdowns are on average like 70%, I will take 70% off that value just from the high. And that's the value that I want to anchor in my mind, because at some point that can and will happen unless if I trade around my positions. But for my personal long-term holdings, I don't. I just hold them, and it is what it is. Now, I want you, but when you do this, you really need to truly consider what it would be like and feel like to see the number on your headline of your account. Like, you can even make a fucking mock-up like this. So for Fidelity, you just got over $1 million, big monumental accomplishment. You should immediately cut that by whatever your average drawdown is here. It's like 30 and 35% or something like that. Anyways, my point is that's your real value. Because also think about it this way as well. Not only is it inevitable that you will at some point experience a big drawdown, could be bigger if you're in crypto, could be less so if you're in traditional markets, but also when you actually do exit, according to your investment plan, you're probably, or you should be looking for an objective signal to exit. And I know for myself personally, I will never exit at the exact all-time high. So that value is never even real to begin with. I will never have that. Never, ever, ever. It does not exist to me. It's just, I mean, they're not fake numbers, but they are imaginary numbers on a screen, pixels that will change when they actually get realized. Why? Because I personally would like to see some sort of objective signal that the current trend is ending. And if the current trend is ending, then naturally price is going to be decently off of the current highs before I even recognize and can confirm a trend reversal, because that's just the way that they fucking work. And so even if I am exiting for profit taking, I also understand that, hey, it's not going to be that top value. It's going to be probably 15% less than that, or 20% less, or whatever it ends up being. It depends upon my methodology. I need to take a sip of this water, by the way. So yes, bookmark that as your real value. And journal about that moment as well as your account valued as an all-time high, knowing that at some point it will drop drastically below that number, because you're going to want to reference that when you feel the other side of that emotion, because it naturally will very likely happen. And focus on that feeling and prepare for what the future will feel like, because you can actually prepare for that. It's like, it really is like going to the gym. You can train your body and your muscles just like you can train your mind by going to the gym and doing the repetitions. This would be like doing the repetitions for training your mind in that way. You're training your mind to actually interpret it and prepare for that situation, just like you train your body to be able to bench press, 300 pounds or whatever it ends up being. Anyways, why? Because at some point in the future, during the next drawdown, that will be, your real value. Again, somewhere around that average drawdown. Again, go for a minimum, go for a max, do everything in between as well. But you want to anchor your mind on that valuation. So, it's not so much of a surprise, because that's what you expected to begin with, because you knew that it was possible due to history. Thus, it was already coded in. And reference this, like I said, reference this journal that you're creating when the drawdown comes. Keep in mind, if you exit, it will never be at the high. At least that's one of the notes that I always remind myself. Maybe you found a way to exit at the exact high, in which case you did. You can feel free to let me know in the comment section below. Anyways, and then also when your investments are on a bear market, so the opposite side here, we know with an absolute certainty that if held long enough, which if you're holding especially Bitcoin for more than 5 years, or traditional market assets for more than 10 years, you will inevitably enter a bear market with a sizable downside correction. And during a bear market, as we went over earlier, emotions are heightened due to the relative loss psychology principle, more so even than the euphoria time. So this is extra dangerous in my experience. If you plan to hold for 10 plus years, then we should expect, 1 to 3, maybe even more outsized corrections. I mean, especially recently, I would say we had probably 3 outsized corrections in traditional markets over the past 5 years, maybe even a little bit more than that. But yeah, they happen. Anyways, the same antidote really applies here in essence. We need to reference the past and ask ourselves, are we within the context of what is expected? Those average drawdowns, the time in those drawdowns, the minimum, the maximum, what we've seen across other assets, similar asset classes, these sort of things. If the answer is yes, relax and go touch some grass. It's going to be fine, or at least we have not been shown data yet that should dissuade us from our initial investment decisions. Nothing's new. All good. Do something productive elsewhere. That's the best thing to do in these cases. Do something productive elsewhere, whatever that is to you. Maybe that's going and making more money somewhere else. Maybe that's hanging out with your family. Maybe that's, I don't know, building something. Whatever it is for you, do something more productive, because obsessing over the charts at this point is not going to ultimately help you. It's better to focus on something else. It also gets your mind off of this initial issue as well. And realistically, the only decisions that you're going to make in that state are going to be bad, because you're already doing what you should be doing, which is just holding, assumedly. If no, has a fundamental change occurred, or has your exit conditions for your initial investment thesis or investment strategy been hit, meaning that when you set out that initial investment, not only do you need to have your entry and profit taking objective indications defined, but you also need a risk management definition as well, which also should be objective. So has that been hit? That could be a moving average cross, that could be a certain number from an indicator, that could be a combination of many different things. Whatever it is, if that condition is met, okay, then yes, we do take an action because that was pre-planned. But if it was not, then we do not. And if the fundamental change has not really occurred, like something really significant, then you're going to have a hard time rationalizing that. Or, I mean, you're going to have an easy time rationalizing it because you're in an emotional state, but you're going to have a hard time making the proper decision, without reflecting on that. And again, remember the initial assumptions. Always go back to that initial journal where you set out the initial strategy, all of the objective indications for entry, exit, and risk management, and there should be more in there as well. That's really a minimum. That's really honestly a minimum, because of course, this is money that is not needed for daily liquidity purposes. That was one of our initial assumptions. So if that is not the case, then you are deeply fucked and committed the cardinal sin of investing. Just my opinion. Anyways, there's also periods of consolidation. I mean, this is what really trips people up, because it's, like I said, it's easy. You think it's easy to hold through all this, but it's not, because it takes a lot of fucking time. And we get into these, especially the multi-month long corrections on the lows. This was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, more or less a year on the lows after an 80% drawdown. To hold through that is really fucking hard. It's really fucking hard. Capitulation by boredom is a real thing, especially after a big downside move. And by the way, after every big up or downside move, you're usually following a period of major consolidation. So it's going to take time. Anyways, we want to reference past periods of consolidation for the asset after large trending moves, calculate the days spent in a range for each instance throughout history, create a minimum, maximum, average, all of these sort of things. Basically the same sort of, of method as, as the prior two instances, but this time just deployed to consolidation. Just being aware that, yes, capitulation by boredom is a real thing. Boredom can also produce some, the environments for some very bizarre and bad decisions to be made. But we need to go back, again, to our initial plan. That is the key for this. It all comes down to that initial plan and referencing anytime that we consider doing, something against that initial plan and saying, hey, is this a yes or a no? Is this a 1 or a 0? Is it a fuck or not? If it's no, then don't do anything. So yeah. All right. And then, so those were all the tactics within the realm of trading and investing. Here are some things that I've found to really help me outside of that realm. So these are activities that have been really, really monumental for myself. I understand other people out there are going to disagree. That's fine. Again, this is just what's worked for me. Take what you will and discard the rest, as always. So these, I feel like, have had the absolute most positive effect with becoming as resistant as possible to making dumb, emotional, impulsive decisions outside of the things that we already spoke about, because those are much more close, but these absolutely help. One would be, and these are in order of importance, by the way, as well, priority, especially number 1 through 3. But number 1 absolutely is 8 hours of sleep. I go to bed at 9 p.m. I fucking love it. I fucking love it. If I'm in bed after like 10, I feel like I've massively fucked up. If I'm even in bed before 9, that's also quite good as well. Because nothing ruins a day better than not getting enough sleep. And I can 100% assure you that whenever you see me have an emotional outbreak on YouTube or anything like that, it's likely because I haven't had enough sleep. Sleep is absolutely key. And of course, that's what helps get your own mind psychology and physiology in the proper place. Without sleep, your brain doesn't have the time to repair, your body doesn't have the time to repair in the necessary ways that it really needs to, and thus you are going to be, at a bigger disadvantage from making those logical decisions. The next one would be nutrition. This one very, very important as well. Personally, I focus on only real food, no processed junk. Basically, if I don't recognize it from, growing outside or anything like that, I don't eat it. So I eat very, very simple things. I eat mostly meat, and that includes fish, chicken, and all, basically anything like that. And berries and fruit. That's what I like to focus on. Yes, I'll do some carbs, some very simple ones like potatoes or rice if I'm training very hard, but those would be the staples. And of course, you generally want to focus on the high quality versions of those. Now, again, they can be quite pricey. I think even if you don't do the organic stuff, it's certainly significantly better than anything than the other choices. That's what I'd say about that. And generally that's what I've done in the past as well. In fact, I used to only eat fucking ground beef because that was all that I could afford. But I still even eat ground beef because it's fucking good. It's really, really good and feel great on it. Anyways, number 3, and also I would say this one's pretty damn close to nutrition, but just a small distance between number 2 and number 3 would be exercise. I personally like to have around 4 sessions per week, 1 day on, 1 day off. As I get older, I kind of need more rest. Now I'm in my 30s, man. I'm in my deep 30s. But yeah, 4 to 5 sessions. When I was younger, I'd do like six sessions, maybe even 7 sessions sometimes. Weights, actually like trying to train for strength, really pushing yourself. And then what's also equally as important, what I think actually probably has a bigger effect, at least for myself, is extremely intense but short cardio. And when I say extremely intense but short cardio, I mean getting my heart rate into zone 4 or 5 for 10 to 15 minutes during those sessions 4 times a week. If I do that, then I'm in a really, really good place. And this actually also has an immediate effect as well. Like if you go and if you go and expend yourself at the gym really in a high intensity manner, it turns something on in your brain that just makes you a lot more relaxed for anything else. Like it's like you've dealt with something that's so intense, so hard, so demanding that anything less than that is just that's not a fucking issue. That's easy. It helps me certainly get into a more logical state of mind. And ultimately, I mean, I think we as humans, just my theory there is that, for hundreds of thousands of years, we've been extremely active, and we generally have rewarding mechanisms in our brain to reward extreme levels of physical output because, that typically correlated to being able to get food, in the past, or to successfully escape a predator, for example. So your body has reward mechanisms for that, for basically making you relaxed after expending such insane energy, even if it's for a relatively short amount of time. So yeah, I think most people have 10 to 15 minutes of like 4 times a week or even 3 times a week, and you can actually make big changes even later on in your life as well. They've done some really amazing studies that 50-year-olds who did these high intensity interval training really changed around their whole heart and general body as well, within a few months of training and being consistent. It's amazing. Anyways, number 4, daily meditations, 15 minutes. This, I like to do like 10 to 15 minutes per day. This one's super, super critical for myself. Maybe other people out there disagree, but it just helps me refocus on the present moment, recognize my thoughts and emotions are fleeting, and I cannot control those directly. So it makes me trust my initial emotional response to something because I know that that's it's like I don't even control that emotion to begin with. Like when you sit there with your thoughts and just random shit bubbles up, you're like, where the fuck did that come from? I didn't think that. And then you recognize, oh shit, I'm just, whatever I am that thing that is experiencing that thought and just analyzing it and seeing it. I'm not actually that thought, and that'll naturally just go away because I'm not that thought to begin with. So when you get into those, it just kind of, again, helps inoculate yourself from getting into those highly emotional states, and super, super useful in my at least for me. Anyways, my next one would be read or listen. It's also fine to listen as well to books and podcasts. I mostly listen actually, but I love listening to that sort of stuff. Always trying to learn something new. That again, being more productive than just fucking obsessing over charts. Go for a walk outside. I love that, preferably with good trees. Good greenery around you. That's very, very nice. Makes a whole hell of a difference. There's something very relaxing about that as well. Generally, and this one's also, I think, quite powerful, limit mainstream media, social media, and toxic relationships. Most of these things are, entertainment that is designed to excite you in an emotional way, both positive and negative, mostly negative, because that's a significantly more strong emotion, as we went over earlier. Thus, the news is really incentivized to make you as emotional as possible, typically negative emotion, as we went over. But again, that emotional state, again, blocks us off from that logical thinking. Thus, we go ahead and do dumb shit, which we don't want to be doing in successful long-term investing. And then number 8, you can chat with someone around you, chat with your significant other if you have one. Like for myself, I have Elsa. It's beautiful. It's amazing. We get to hang out every day. Or chat with, if you don't have a significant other, maybe work on that. That's also productive as well. Or chat with your favorite AI. Those can be very, very helpful conversations. Anyways, and actually really do mean that, by the way. Anyways, that's what we'll end on this particular presentation. I'm going to continue with this long-term investing series here, I guess. I don't really know what to call it, as I come to my own revelations. And honestly, I've been having a lot of fun putting these together. It's been extremely helpful to myself. I'm really glad to hear that that people seem to enjoy it as well. And if you have topics that you'd like to see covered, feel free to post them in the comment section below. If I feel like I have something of value to add, then perhaps I can do a video on those. But yeah, the whole series is here for you as it stands, and there's actually plenty of videos in there right now. So check it out if these things interest you, and I'll see you in the next one.